And now on to the markets. As we've said all year long, this bull market has strengthened. It has deflected all kinds of bad news. The doubling in interest rates in the first quarter, the Archegos leverage blow up in the ecosystem, which many thought could cause systemic problems. We've been through tax hike discussions, which sounded pretty onerous in terms of their impact on capital. And we've seen a big correction. We certainly were right in the middle of it in valuations as those interest rates went up in the higher valuation side of the market, particularly if one is looking at valuations as of this year on this year's earnings. So we're very happy at the way the market has performed. It's up double digits, and we've seen now a shift, a rotation back from value as some of these prices have started to unwind, the commodity prices in particular, towards growth. But I think we're going to see toggling back and forth until some of the confusion that I'm discussing here dissipates. What's clear is profit growth right now has been or is explosive. I think for the second quarter, at an annual rate, the S&P is annualizing earnings at $220. So that's roughly 20 times, really effectively trailing earnings. And if we think earnings are going up, and we do, then the multiple looking forward is moving down into the mid to upper teens. That is good valuation support given the level of interest rates. But if we're right, and there is an inventory cycle brewing here, and there are wage pressures brewing. I mean, we hear headlines of all the labor shortages, and in fact, the JOLTS index, so that's the job openings index, it shot up to an all-time high, another all-time high. 9.3 million jobs are just waiting to be filled. There is either a skill set mismatch or the wages are too low. And so we are seeing a lot of industries increasing wages to try and attract labor. Now, we do have many people still out on their stimulus checks until the end of September. That's in the lower wage categories. So that supply will come back in, and JOLTS, that number, 9.3, will go down. So that could take an edge off of the inflationary ramifications and the margin pressures associated with wages. And I do believe if we do go through this inventory cycle, and we see some profit pressure caused by costs, especially wages, that the market will become more discerning. I think that this shift towards growth will gain more momentum if this happens, because cyclical earnings growth will provide less competition.